Good morning, everybody. I'm delighted to be here to talk about disruption and what that means. I'm going to be able to approach it from both ends because for 7 years I was chief executive of LoveFilm and talked a lot about it, and I actually did quite a bit of disruption. For the last few months, I've actually been chief executive of Mothercare. That if many of you are mums here, you've probably experienced the business that I run for quite a while. Now, the challenge is that is a business that over the last 51 years has actually been disrupted. Has actually seen at the bottom end supermarkets, sort of offer and redefine the value proposition and in some respects the service proposition. And at the top end from designers has actually lost its way a bit there as well. And actually what my job now is to bring the customer back at the heart of that business with a lot of the LoveFilm learnings. So let's talk about, first of all, the customer proposition. Right, so I'm going to begin with LoveFilm and then talk a bit about Mothercare at the end. And I hope some of these learnings are going to be relevant based on really what we've just discussed and also part of the introduction. And the key thing, our proposition essentially was three things. It was to ensure that we get the right blend between how customers find the films that they want to watch, how they can watch them. And for us, actually at LoveFilm at the time, it didn't matter whether they watched it as part of our subscription service or whether they went to the cinema or they watched it on mainstream TV. We just wanted to enable people to access content so they didn't have that cognitive dissonance of just trying to find film after film after film or understand what they want. And then ultimately, we wanted to enable and create a vehicle by which they could share that experiences themselves. And our proposition, very much as the proposition that we talked about at the time, was all about value, choice, and convenience. And those were the three tenets that we built the business on. So I want to tell the story slightly differently than I would probably normally tell the story. And that is to go back to essentially a love film and a love story that is going to be really important at the heart of what we do. And I noticed the theme today was all about loving customers, and actually with love, the name above the door, I think it's really important we do that. And the most important thing, and the way I'm going to do it, is actually to run chronologically through some of the key things we did. Number of reasons that may help you. If you are at a business or at a different stage, you may see what we tried to do from literally a startup situation, ultimately through to selling that business to the largest retail business on the planet. And then secondly, I think it's just an important way to try and trigger in our thoughts some of the different themes. Now, I'm going to start with not a great film, I understand. All right? Three Men and a Baby is not one of those Hollywood classics, but nevertheless, it's sort of in the early days in 2004 represented where we at the time, LoveFilm, was very part of, which was we had 3 VCs on the board. We had 3 founders who were all working together after we merged a couple of businesses. And what they were trying to do is they were trying to understand what business model would work. They were trying to understand how their baby would develop. And this is a really important part in any company's existence, which is the storming and the norming and the focus and the testing, everything that goes on to try and understand what are the critical things that make a difference to the customer at that stage. And a lot of the pricing work, the proposition work, the web work, the attitude that we spoke to our customers with and how they spoke to us, which is even more important, was formed in that very early stage around 3 Men and a Baby. But by 2005, actually, we got some of the big guns, right? We got Paul Newman and Steve McQueen in to help us. And being a startup at that time, what was really important for us was cash burn, right? Don't worry, the puns do get better. But we had to focus on the expenditure that we were having as a business. We were a subscription business, right? And the advantage of a subscription business is you can get cash in from your customers on a regular basis, on a monthly basis. However, the challenge for us was to ensure that all that cash, we could preserve as much of it to help us grow the business, because we were growing the business at this stage around about 50% a year on year. And we needed to ensure that we didn't need to go back to the VCs, we didn't need to go back to the markets to get more cash, and we could use it. So what we did is we did 2 things. One of all our marketing was pay for performance marketing, which meant that actually we'd do the activity, we'd work with partners, it would all be variable costed, we'd need to get the results, and then once we had the results, we would pay people down the line. So that really helped us in terms of a cash point of view. The second thing is we worked very closely with suppliers at that stage to make it work. And actually we created a positive cash conversion cycle. So what this meant is the loyalty that we got from our customers and how we could use the monthly payments meant that every time we got a new customer, we would increase our cash, which was really, really important for us at this stage, we could put our foot to the floor and grow as quickly as we can and not be constrained and worried about the cash overall was in the business. But the main reason why 2005 actually was the towering inferno was because very early in 2005, in the morning, I had a phone call to say, Simon, you should go to our distribution centre where we manage all the DVD rentals. And actually, there seems to be a fire that's broken out in one of the nearby business units. You may just want to go and check it out. Well, I walked over the bridge in North Acton, which is where our distribution centre was, and I saw 50-foot flames coming out of our distribution centre. Right? This is what it looked like. And we had to decide very quickly of what we were going to do because we were a relatively new startup and we need to decide what was the most important things we could do. And it's often at those critical stages you determine what is important for your business. I got all the exec team on the phone around about 12 o'clock at night. We were on the phone for 2 or 3 hours working out what we needed to do. By 2 o'clock in the morning, there had been an email sent to all our customers saying, oops, we have a problem. And we actually posted a similar picture to this on the website at the time. We got all of our staff together outside on the steps of a Lebanese restaurant in Park Royal, and we said, look, go home, there's not a lot you can do, but give us your telephone numbers. Within 24 hours, basically focusing on the critical customer processes that we operated our business to, and the fact that as a rental business, 75% of all of our DVDs were out with customers, not in our distribution centre, we were actually able to turn this around. And we made about 10 critical decisions at that time, all focused on ensuring the customer, we had transparency and communication, we were completely open, we compensated for people, and of course, and my advice to everybody is please ensure you have insurance at the same time because that is really critical for you. And we were able to, at this time, really redefine the business. And within 24 hours, we were receiving discs, and within 48 hours, we were sending discs back out. And many of our customers didn't actually even know that we had a fire in our distribution centre. And it was all about putting the customer absolutely at the centre of what we did. I was chief executive at the time of a company called Video Island. There was a competitor in the market called LoveFilm, which was doing a fantastic thing with its customers. And actually, in 2006, we merged those two companies together. And bear in mind, in early startup time, you talk about PR, you're really having a go, you're really talking and challenging some of your competitors. In 2006, it actually felt as though, for the first time, we were sleeping with the enemy. Right? We merged these two businesses together in April, and one of the few things that we did is that LoveFilm had great brand, had great marketing, had a great reputation in the marketplace. But what we had at Video Island, we had great systems, great customer management tools that we were able to merge these together. And you'd think it was a marriage made in heaven, and we had to make sure it was. And if you're going through any M&A, again, think about the customer in terms of pulling those two things together. What we did is we moved to joint location, which was a new location for us both rather than old offices. We defined the behaviours and values that we wanted to operate to, and really we ensured the senior team were aligned against all of them. And the most important thing we could do and we needed to do as a team was to communicate the behaviours that were going to be critical for us for success. We defined at this stage these values. We didn't get external consultants in and paying them £100,000 to work on this. We basically sat around in a room and defined what was important. These will be pretty similar to any size company's values. The key thing is, are you living them day in, day out? And if you spoke to any customers, would they believe that they were your values too? So we had ensured all customer, the top 10 customer complaints and the top 10 customer credits were sent to all staff every week. We ensured that we had scoreboards in reception of all our offices showing what was happening in our customer metrics. We did recognition for all customers. And actually one of the things we had to do at the end of 2006 is I had to step in and stop any changes to any system that was going to make the customer experience worse. And actually the organisation thought I was gone bonkers, where I turned around and said, look, I have to sign off any changes that are going to be worse. And the first week I had a couple of things came through, and we actually found a solution that improved customer experience and changed the systems that we wanted to do. The second week I had one, and then thereafter I actually never got another request again for making a bad customer experience. 2007 was actually our go big or go home year. right? And the reason I put Braveheart in here is we did a small test in Scotland on TV. And we had £2.5 million in the bank at this stage. And we decided at the beginning of 2007 to actually bet £2 million on a national TV campaign. We needed to get our brand out there for the first time, and we needed to state this new organisation that we just pulled together, actually, that we were serious in what we did. And we did, and we invested it. Now, you think at that stage that, you know, that's big risk-taking, that's what a lot of entrepreneurs do. The truth is, I think entrepreneurs are the least risky people because they're dealing with their own money, or they're dealing with, you know, cash in the balance sheet on a regular basis. And what we did a lot of is we measured every single piece of activity that we did. Right? This goes back to the big data point that we were talking about. And we could even, in some case, you can see the orange line at the bottom here, you could see sometimes where we did a big direct mail campaign, we actually pulled forward sales, right, that we were able to do. So we built economic metric models that we were able to really identify. And we knew from this, actually, that the expenditure that we were going to do in TV was sort of going to pay back and sort of going to be break even. And with a subscription business, it's all about the cost of acquisition and the lifetime value of the customer. And we were able to really get into a lot of detail about the analysis. In 2008, we actually had a lot of approaches from companies, and a lot of big media companies came to us and said, well, you're reaching an interesting stage in your development. Maybe we should talk about some of the acquisitions or maybe being acquired into our business. A lot of them were tire kickers. They wanted to see what we were doing as a business at that stage. But I would say it's safe to say that some of the big boys came out and sort of started to throw their weight around. During this year, we actually were able to secure a deal with Amazon, whereby we acquired Amazon's online DVD rental business, and they became part of our business. And Amazon became a shareholder within our business at that time. And we were able to integrate all of their customers onto our platform in a very short period of time. And you know about Amazon, they're absolutely maniacal about the customer experience, and that's what we had to prove was the best thing that we could do during that process. And the whole of that transition of all of that customer base, we lost less than 5% of customers as they moved from an Amazon online DVD rental customer to LoveFilm because of the migration work that we were doing at the time. But the most important thing that happened at that time, you can imagine here that we were beginning to see the early stages of the recession coming through, but we had to very much focus on the product. And this is the reason why The Godfather to me is important, is because it's all about giving a customer a proposition that they couldn't refuse. And we did a lot of analysis of understanding what the right customer proposition was. You know, you'll be amazed by how much you get in terms of click-through just by changing the photo on your web page around propositions. Trust me, it was truly amazing. But we also found that we were pointing people in a direction of our particular packages that actually probably wasn't the best value package out there. So by changing a lot of what we did, by simplifying it, we thought we were pretty clear because we talked about our packages for a long period of time internally. The truth is our customers were confused, so we had to streamline that very much. And that became particularly relevant when we got into 2009, when actually the staying in was the new going out. There was a lot of new activity going around, and it was all about the recession that was hitting. Lehman's had happened. There was a lot of concerns of the household, mortgage rates and things. And actually, so this became our Groundhog Day. Right? We had to literally go back time and time again and test every one of our activities, our direct mail activity, our social activity, all the things that we were working on to try and drive as much efficiency and as much value out of them as we possibly could. And our ultimate goal was to ensure we really gave the best possible experience. And we began to see at this time that the most important thing for us was word and mouth. Right? I think we've touched on it earlier, which I think is absolutely spot on. So it wasn't just word and mouth over the garden fence, which is what we saw in the 50s. It was what was happening on social networks. It was what was happening everywhere. And importantly, we did some interesting analysis just around this time, and we looked at, by postcode, what was our market penetration. We were running at about 5% of households in the UK at that particular time. And as you see here from the analysis, when you break this down, we looked at what was the change in penetration versus the penetration rate itself for different levels. So on average, running here about 3%, and we saw that over the time period we were looking at, we were able to grow our penetration by 1%. And essentially what this was beginning to tell us is that word of mouth was delivering real benefits to us as a business. And we were growing fastest in our highest penetrated postcodes. And as a chief executive, this was the, if you like, this was the most relieving slide that we had in the business, because what it said to me is we were nowhere near saturation. We had a huge opportunity to continue to push this business and to continue to drive. And if we could get to that critical tipping point of 2 to 3% household penetration, we would actually then begin to accelerate our growth rather than decelerate it. Now, social networking obviously became the petrol on the fire for us at that particular time. We were everywhere. We had teams internally that were managing it. You know, again, I'm a huge believer in you never, ever go on social networking sites as members of staff not saying who you're from. That will backfire in an absolute instant. You are open that you're there with LoveFilm. You're open that you're creating the noise. And if you remember the PS3 situation, where there was a big outage on the Sony PS3. Again, you know, you're all aware and familiar with what was happening at Sony at that time. There was delays, constant delays. Everybody who was watching LoveFilm through a PS3 at that time, we actually gave them a £5 credit and said, sorry you can't watch, but we know it's not our fault, but here's £5. And immediately, the groundswell of support that we were getting, not only from our customers, but from outside of our customer base, was phenomenal in terms of LoveFilm actually helping us in a situation that's not theirs. And this was probably, that year, some of the best marketing money that we ever spent in terms of beginning to build that word of mouth and beginning to see what was happening. The other thing that's really important, and we talk about this is net promoter scores. I know there's lots of other measures around ease of use, etc., that are lots of trends, but we track this on a regular basis. But one of the most important things for us is that when you're sending out 1 million DVDs on a weekly basis, you know what? Stuff happens, right? Things go missing, things get broken, things get damaged. So what we needed to build was a customer service service that actually reinforced our proposition of caring for our customers. And what we found, and if you had a look at the box at the bottom here, is actually our net promoter score was higher when people experienced problems with us. So actually our customer service and our call center and how we managed that whole thing was actually adding value to the loyalty from our customers and was driving that. And actually that was a big advantage for us. And all the time, therefore, our customers felt if there was anything ever wrong, they'd pick up the phone to LoveFilm and they would actually experience, have a great experience that resolved their problem. And the basic principles we had at that stage is the customer's always right? And actually working with them and how that works. So 2010, it became a little bit more serious. And we began to have serious discussions with a Seattle-based company, Amazon, about their interest in the business. It took a long time in order to have some of those discussions. And I think why we began to have more detailed discussions is we were growing the business quite significantly. We'd averaged, as I said, at that stage, we were running at about 60 to 70% annual growth in the business and a lot of referrals coming through customers. Technology was driving the business, and in particular, in the UK alone at that stage, what we saw is that we had just over 1 million customers, but there were 20 million customers who were connected to a film watching service that we could target, whether that be through games consoles, whether that be through DVD players, or whether that be through the existing subscription they had. So a lot of opportunities for us to really begin to accelerate. And so we built a team that was really focused on satisfying against that digital service. And there's one big difference in a digital business versus a postal DVD rental business, is that suddenly we were a broadcaster, and that broadcaster meant that we had to think about everything that we did real time. So all of our customer services, all of our recommendations, all of our services that we provide actually needed to change quite dramatically. And at the end of this, right, 2011, we were finally able to close the deal. Anybody guess why 2011 was Jerry Maguire? Yeah, show me the money, right? So they had to put their hands in and do that. And it was absolutely the right thing for the business, and the business has continued to thrive and continue to grow and have the investment it's required to get the content and the services that is needed for its customer base. And as you know, Amazon is an incredibly customer-centric business. And there's one tip here that I learned from them, which I think is fantastic, which is before they do any technology project, before they do any initiative, they write the press release. And they write it in a way that's not 4 lines and unused, but they write it a lot of details. And then they stay true to that press release whenever they're doing their development. And if they find in all the technology works, or the projects, or the initiatives they're doing, it does not match up to an improved customer experience, they stop it at whatever stage they're going to do it. And I think that's a great insight into how that company and what they've done. So we were able to do that. We were able to, Amazon take over the company. Earlier this year, I left, and so 2012 for me is a completely different customer set, right? It's going to be about how can we engage mums and bring them into the business. And as I talked about, this is a business that hasn't had for a while the customer absolutely at the heart of what they need to do. There are over 400,000 new mums, probably going to increase actually, given the Olympic factor that are being created every year. 80% of them come into a mother care. Our challenge first is conversion and get those, and then when we have conversion done, when we've got the right products and the right services, actually to build the loyalty schemes and to build the initiatives that will enable those customers to come back and live with us as their family begins to grow. So it's part of a 3-year turnaround plan, a 3-year strategy that I've already outlined in general. But again, for this business, we need to bring the customer back at the heart of what we do. So that's that.